Hello, listeners. Welcome back to another episode of Cognitive Dissidents. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Joining me for our weekly chat on geopolitics and markets is Rob Laherty, our chief investment officer. We talk about the U.S. inflation print, economic problems in China, how Japan is going to react to some of the U.S. pressure to get tougher on China, some optimistic thoughts about Europe and Brazil before closing with a canary in the coal mine. You'll have to listen till the end to get to. Otherwise, we had a couple of technical difficulties in this podcast, but I'm pretty sure our fearless producer, Jacob Smoolian, will iron them all out. So if you haven't left a rating or a review of the podcast, please do so. If you want to email me at jacob@cognitive.investments with any thoughts about this podcast, please feel free to do so. We can also talk about what we do over at CI if that interests you. Otherwise, take good care. Cheers. See you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Good morning, good afternoon. Rob, how's it going, man?
It's going well. How are you doing?
I'm hanging in. I know you don't want to talk about the Fed, and people can go consume, every other. I usually, when I wake up in the morning, I try and watch foreign news in the morning. I particularly like Singapore's Channel News Asia, but I kind of bounce around. It's been very annoying the last week because for the last couple of days, they were all talking about U.S. midterms, and then now they're all talking about the U.S. inflation print. So I feel like I'm getting literally one story in my ears all over the place. And listeners, we don't want to give you that same story, but we also know there's an elephant in the room. So let's just say for 3 minutes, very briefly, there was a U.S. inflation print. It was a little bit lower, I think, than market expectations were thinking. Markets this morning are surging as a result. We're here Thursday morning, 9:45 New Orleans time. It's about happy hour, or I guess it's always happy hour in Paris, isn't it, Rob? It's probably always wine and cheese o'clock there.
Well, happy hour starts at 12. Let's keep it reasonable.
Yes, I can't remember who the French philosopher is who said that a meal without wine is like a day without sunshine. But I know that it was a French philosopher who came up with that phrase, and I use it all the time. And I should really commit his name to memory. But anyway, dollar plummeting, treasury yields plummeting, equity markets surging this morning. I don't think we have a ton to add to folks. I think for us, we're still in kind of wait and see mode. Just because there was a lower than expected inflation print doesn't mean that Jerome Powell is convinced that he has to stop the rate hiking party, even if the market is now pricing in 25 basis points below what it was before in December. So I know you don't want to talk about it, Rob, but for 60 seconds, just tell the listeners what you would tell them to keep in mind, and then let's move on to more interesting stuff.
Well, the first thing to keep in mind is that you always have to take the initial market moves with a grain of salt, because the initial move is always the quantitative algorithmic move. And right now, all of these trades are moving together. So currencies, bond yields, risk assets like equities, they're all the same trade. And the algorithms recognize that. And they recognize immediately when the headline print is lower than expected. And that sets this sort of chain reaction into motion, especially in the treasury markets where liquidity has not been particularly good. Treasury yields are really whipping around a lot. So I guess the first message would be chill out, wait for things to digest a little bit. If you're making any decisions based on, the market action of a few hours, then you're probably not for us. But you need to just sort of wait and see a little bit. The other observation would be that it really is one of those times, and this happens in all sorts of market regimes, like sometimes it's the payrolls number, sometimes it's the inflation print. I mean, we've seen whatever the focus was change. In the 1980s, everyone was obsessed with the M2 money supply numbers. Now no one even pays any attention to them at all. Yeah. But there's always one thing that everyone is super, super focused on, And I find that it's not very fruitful to spend too much of your effort trying to outwit everyone. You're never going to get some edge by outthinking someone on the thing that everyone is thinking about. You want to pay attention to things that are happening at the margin that aren't really in focus so much, because the media cycle is just going to chew itself out on this topic, and all sorts of points of view are going to be kicked around. And it's fun to listen to, but I'm not sure if it's very profitable to engage in.
Well, with that, I mean, it's happy hour in Paris, but we'll take that sober look and say, if you want to learn about the Fed and the inflation print, maybe go read the inflation print yourself on the Bureau of Labor Statistics website. Don't read it from sort of secondhand sources. And if you want some commentary, literally every single financial media publication out there is talking about this. We will sort of leave ourselves to digest it and maybe come back with some thoughts in a week or two. Let's try, though, and dive in for our listeners about what's happening in the rest of the world that's being ignored, because it's all U.S. midterms and all U.S. inflation print. U.S. midterms, by the way, is a similar story. We still don't have results for key elections in sort of the U.S. Senate and the U.S. House. So I've been asked a couple different times, what does the midterms mean? I have no clue. We don't have the results yet. Until we have the results, it's not good. I can tell you, man, the Chinese perspective on the U.S. is a declining power. The fact that we have to wait multiple days for Nevada to count the mail-in votes, like we really can't come up with a better system. My God. Anyway, I won't even go down that rabbit hole. So let's move to other places. As usual, I think China's the kind of the big deal here, and there's been a lot of talk about China in the last couple of days. After we recorded last week, there was I would call it a surprising spike in sort of Chinese markets on this rumor that China's reconsidering its zero COVID policy. I have my doubts about that, and the one doubt I didn't have, and we actually alluded to this in the podcast last week, Rob, because right before we recorded, Olaf Scholz, the German chancellor, was on his way to Beijing to meet with Xi Jinping. And that was an interesting meeting for a lot of reasons. But one of the things that came out of that meeting was that China agreed or approved the BioNTech Pfizer COVID vaccine for expats living in China. So not for Chinese citizens, but they agreed to let expats have that vaccine in China itself. And that might have been an interesting lily pad to, okay, now they're going to get a COVID vaccine for the rest of Chinese citizens. Now we actually have a path towards reopening. The official communication from the Chinese government at every single point of the last week has been, this is all bullshit. There is no relaxation of zero COVID underway. The strongest denial came out this morning. Xi Jinping apparently saying, yes, we would like these COVID restrictions to be a little more targeted, but we're not swerving away from zero COVID right now. I think the bigger thing that people are missing, and we talked about this a little bit last week, the Chinese finance ministry came out last week and said, we're piloting tax reform in Shenzhen, and we want to reduce inequality in China. We want to use taxes to do so. That's a big deal. The real estate crisis is still happening in China. That's still a big deal as well. So I thought we might just talk a little bit about China, because I think that's actually the thing that moves things in a more general direction. Even amidst all the market optimism today with the inflation print, oil is lower, and everybody's ascribing that to fears about reduced Chinese demand. So I don't know how it doesn't make sense to have markets surging on the one hand, but oil declining because people are afraid China's not going to be in action. So I thought we would just kind of set that up and maybe talk through that a little bit.
Well, to start with the market action, I think if you were to look at the chart of Chinese equities, whether you're looking at Shanghai or Hong Kong, what we're seeing is not really evidence of a sustained turnaround yet. We were in deeply oversold territory heading into the last 2 weeks, and we've seen a vicious rally off of those lows. But at the same time, all we've really accomplished is clearing some of those most egregious oversold levels. So the downtrend, in other words, in Chinese equities still appears to be intact. Maybe that will change as things dig in a little bit, but bottoms like this are a process. You almost never get a V-shaped recovery out of a market move like this, and then you're just off to the races. So I think it's too premature to draw any conclusions around market action. And so far, I think the market is just showing us that, hey, this is a bit of a kickback in what remains a downtrend. So the second thing that came out this week which is noteworthy, is the aggregate financing number for China came out. So this is the aggregate amount of credit across the entire Chinese economy. And it came out for October, and the number was really bad, really much lower than expected. So this notion that they're pushing stimulus through, that they're sort of engineering a rebound in fixed capital investment does not appear to be playing out on the ground, at least as of the end of last month. So this is probably creating a bit of urgency. The third observation I would make on the tax reform, which you brought up, which I think is really important because, again, I just have to copy Michael Pettis in this because I think he's the most thoughtful person on China. And if you're not reading everything that he writes about China, what are you doing with your life? But he, I think, has made a very good point in noting that a lot of the talk about redistribution of income from wealthy households to less wealthy households and these sorts of reforms around tax and these issues that are coming up now in many ways distract from the key issue, which is that it's not imbalances within households, which is really more of a developed market thing. Like in the US, that's really relevant. In Germany, that's really relevant in terms of the aggregate economy. In China, the real imbalance is not within the household sector, it's between the household sector and the government sector and the corporate sector. So in our podcast, when we talked about China on the treadmill to hell, one of the things we noted was that the amount of savings retained by the government sector in China, the local government sector in particular, is an order of magnitude higher than other areas. The local government is keeping too much of the economic surplus and reinvesting it itself. So until she or his policymaking apparatus is comfortable enough to redistribute income away from local governments and toward households and stop fiddling around within the household sector, they're never really going to address the core problems of imbalanced growth, too much savings in the economy, not enough consumption, et cetera, et cetera.
I read everything Pettis writes. I'll confess to you, I'll be vulnerable for a second. I don't always understand everything that he writes. I feel like he's been talking about the same thing over and over again. And I get like 3/4 of the way through his articles and I think I understand, but then he like muddies up the conclusions and then like China keeps going on the treadmill, even though he says eventually they're going to hit the windshield. Maybe he'll be right eventually, but I don't know if anybody else has that experience with him. I think that's a fault of my own. It's rare that I come across a thinker where I'm like, you're working on a level that's a little bit beyond me, but I have that experience with Pettis sometimes too. I think I also just want to point out a couple other sort of specifically geopolitical headwinds that China is facing, all of which have kind of blipped underneath the radar. Well, not underneath my radar, but probably underneath the radar for most people. Which is, there was this story about how one of China's homegrown aerospace companies secured another order for 300 more planes for a C-919 passenger jet. The people who lose there are Boeing and Airbus. And I want to talk about this just because I think everybody knows about the semiconductor restrictions right now. But the other big thing that's happening with China is not that China's erecting tariffs and formal trade barriers with US companies and European companies. It's that these domestic champions, they are beginning to rise a little bit. And Chinese industry, the Chinese government has every incentive to support those against the Boeings and the Airbuses and things like that. So that's the things that happened. I think it's also interesting that people ask me about Taiwan all the time. I'm pretty sure that China's not going to invade Taiwan in the next 2 to 5 years. The rejoinder to that is I'm always much more worried about what's happening with the Philippines. And for the last, ever since Xi came to power, they've been trying not to flip the Philippines into a Chinese ally. They would love that. But to get the Philippines, which has a defense treaty relationship with the United States, to not be so close to the United States. And under the previous Duterte administration in the Philippines, China made some headway there. Duterte was much more, while he wasn't, killing drug lords in the Philippines and saying crazy things in his speeches, he was open to better relations with China and really downgrading cooperation with the U.S. The new Philippine president, seems to be going back to the U.S. So there was a report this week that the Philippines is going to work with the U.S. to speed up projects under the Enhanced Defense Cooperation Agreement. That's that agreement where the Philippines and the U.S. support each other geopolitically. That's really bad for China. Like if you're going to lose the Philippines there, you really have no chance of doing anything in the South China Sea. And I think of the Philippines as a place where China is going to be willing to test the U.S. more so than Taiwan. It's already did it. It did it in 2012 at Scarborough Shoal. That's like the key flashpoint for me in the South China Sea, and we saw a big story there as well. The last thing I would just say is that I mentioned the Scholz visit to China and in the context of vaccines, but the other interesting thing there is that Scholz was very much trying to be pragmatic with China, which is interesting in and of its own right. Germany pursuing its own independent foreign policy that is not aligned with the United States. That's been those edges have been smoothed out a little bit because it's not as stark as it was underneath the Trump administration. But I do think there's been a sea change there in the Berlin-Washington relationship. And you see that with Scholz going to China and trying to reach some kind of different arrangement with Xi than what Biden is supporting. But the flip side of that is that in his own coalition, Scholz doesn't have support. So Germany's economy minister blocked the sale of a German microchip factory to a Chinese investor this week. His coalition partners are saying, you're betraying your agreements to us that we agreed to before we came in here. So even if Scholz wants to do something with China, he's facing a lot of opposition at home. And that's, again, a bad thing for China. The point here that I'm just leading up towards is just seems like a lot of bad news for China, no matter which way you kind of slice it. In the short term here, I see nothing that makes me feel good about the short-term prospects for the Chinese economy. And in some ways, I think that's way more important than like, okay, we're going to have a 50 bip hike in December versus the 75 bip hike in December. If China's dealing with all these crises, it doesn't matter what the bips are. Like what matters is that the second largest economy and the factory of the world is really struggling and is going through this major transition point. And that just continues to beat me over the head as I kind of read through my flow of analysis and intelligence each morning.
So a few questions in there on the Philippines thing. How do you reconcile that development with this development that happened in Japan this week, where the U.S. is essentially reducing its presence in Okinawa from a fighter jet standpoint and sort of Air Force power projection standpoint? Is there something weird about Japan? Is that something where they're emphasizing Philippines over Japan? What are the U.S.'s incentives in that area, do you think, now? And how should we be reading the tea leaves?
Before I answer that question, did you know that where do you think the phrase reading the tea leaves comes from?
I don't know, China?
That's what I thought too. It doesn't come from China at all, even though China's where tea production has been going on for millennia. It actually happened that when the Europeans started importing tea from China, this whole class of like European fortune tellers in like the 1800s created this idea of reading the tea leaves as prophecy, and they ascribed like ancient Chinese mysticism to it to give it some kind of credence. This is not to say that the Chinese don't have a version of this. It's just that their version, which is the title of an excellent Peter Hessler book that if you haven't read, listeners, you should check out, is Oracle Bones. So they would carve questions into ox bones and then heat them up, and then somebody would go interpret the cracks of the bones themselves. So I think the actual Chinese phrase would be something like, reading the oracle bones, but the reading the tea leaves is, you would have thought it's a Chinese thing, but it's actually a very Western thing. That kind of hit me. I don't know what, I don't know. I discovered that this week, and now you all know. You're all better for it.
All right. Well, read the bones for us, Jacob.
Oh, yes. Okay. Here, let me just get my ox bone off the fire here that I have sitting in the background. So Okinawa is sort of its own thing. That's always been controversial in Japan. And honestly, if I haven't actually seen the report you're talking about, but if the U.S. is talking about withdrawing from Okinawa, that's in some ways doing a solid for the Japanese government, because they can take that sort of pressure point off of them. Okinawa doesn't like that there's all these U.S. military assets there. They complain about it all the time. The second thing is Japan doesn't really need the help. I mean, if Japan's serious about all this militarization that they're going to do, the U.S. is probably looking towards a future where Japan's not really going to need the help, but some of these other areas where the United States is going to need to be better forward deployed. So I wouldn't worry so much about that. I think that's more about take a political pressure point off of Japan. maybe, move your resources around a little bit in a way that allows you to project in other places. It's much more important for the US to show support for Philippines or South Korea than it is for Japan, because Japan is so squarely locked into the US security alliance. So I think that's how I would go there. Not the flip side of that, but another thing to think about, and this was a report that came out this week, going back to those semiconductor restrictions with China. The White House is pressuring both Japan and the Netherlands to sign on with these pretty severe semiconductor restrictions on China. And just the fact that both Japan and the Netherlands haven't said, cool, we're already on board, tells you a lot. Because even Japan, which in some ways has more to fear from the rise of China than any other country in the world, certainly has more to fear from it than we do in the United States, they're not willing to do that quite yet. And they're not willing to do that because so much of their economy is based on China, especially those semiconductor companies. A lot of assembly and low-end assembly of semiconductors is still happening in China for these companies. And again, this goes back to one thing I always say: the biggest geopolitical risk in the Indo-Pacific is actually not China right now, because they're too weak to be a risk. It's the United States. The United States is trying to reverse globalization on the fly, and the White House doesn't seem to. I don't want to say doesn't seem to realize this, because they're smarter than I am. I'm sure they have the data, but they're shooting off their own leg with these semiconductor restrictions. And then if they're going to go after their allies and say, you have to go on top of it too, you're also just building bad will there. It's sort of a Dr. Jekyll, Mr. Hyde, where Dr. Jekyll is U.S. globalization, and then Mr. Hyde is this protectionist monster that's coming out and is telling everybody you have to do exactly what we say, otherwise you're not an ally anymore. So I think from that economic perspective, it's going to be like Japan is going to face some difficult decisions there. Last thing I'll say on this, and this is a point that I get from John Toland's excellent book about, I forget what the name of it was, but it's his long tome about the rise of the Japanese Empire in the early 1900s. He talks about one of the reasons that the US and Japan eventually had a conflict was because the Japanese political establishment is much more comfortable with contradiction than we are in the United States. So think about, in the United States, you're either with us or you're against us. There's the axis of evil. We have all these, we represent democracy versus authoritarianism. Japan doesn't have that. They're much more comfortable with, yes, we have a geopolitical threat here, but we have economic interests and we want to be pragmatic. And Shinzo Abe was a great example of this. He was the person who led this charge for the remilitarization of Japan while also having a very tight relationship with Xi Jinping. I mean, if he hadn't gotten sick, maybe there would have, and if COVID hadn't happened, Japanese-Chinese ties were actually ascending because of that personal diplomacy Shinzo Abe was doing with Xi Jinping. So I think there's also that in this, that the United States doesn't really understand that Japan has a more varied view on how to express geopolitics, even if they're with us with that China is a threat. It doesn't work for Japan to say, well, then we have to do all China's the enemy. We must prepare for kind of the worst case scenario. They're moving a little bit more towards that direction, but there's a lot more slack in that.
Yeah, it's just like the great book, The Enigma of Japanese Power, which came out in the 1980s and is sort of along the same lines, where so much of U.S. misunderstanding of Japan arises from the fact that oftentimes they'll say things and mean multiple things at the same time. Mm-hmm. Or one group will say something and we say, oh, well, the buck stops with that guy. And no, it doesn't really, because there's all these sort of interlocking interests and balanced views that need to be incorporated in Japan. So that certainly doesn't seem like a new issue. Question, when we're talking about semiconductors and some of these really well-established supply chains that are enmeshed and this sort of thing, do you think that the U.S. still has the stature to force countries like the Netherlands and Japan to toe the line? And I ask that because in the podcast that we published earlier this week, you mentioned the UAE and their unwillingness to abide by the demands around the Huawei 5G standards that the U.S. was trying to impose. And in exchange, they canceled their F-35 jet order from the U.S. And that's for a technology that isn't even really here yet. Can we learn anything from that experience about the prospects for success in the U.S. and getting China essentially closed out of these supply chains?
I mean, that's the $10 trillion question. The way I would answer it is not as much as we used to, but probably more than people think, because you've probably heard me before say that we're on this trajectory towards a multipolar world where there's rising and falling great powers. We're not really quite multipolar yet because there's nobody that can really challenge the United States. We're headed there, like it's going to happen soon, and you can already see. It's sort of like a nice analogy is China gets less productivity for its debt spending now. Like every successive stimulus, they get less economic growth out of it because it's less efficient. It's kind of the same way, I think, here with the US in terms of the application of US power. The US still has that power, but it gets diminishing returns every time it pulls some of those cards. So yes, it can probably put a lot of pressure on Japan and the Netherlands to do some of these things, and those countries have their own problems with China too. So you're sort of getting those interlocking interests there in place. But in general, we are moving towards a place where fewer countries are going to be willing to go along with the United States, and this is part of what I mean about shooting off its own foot. The U.S. And this started not with the Trump; it really started with the Obama administration. Trump doubled down on it, and Biden is going 150% along that line. We built this liberal international order where we wanted everybody to liberalize, and we wanted globalization, and we have a World Trade Organization, and we have the Washington Consensus. We are now the ones that are going the opposite direction. All these things that we're talking about, they have no place in the Washington Consensus. None of this stuff makes sense in a world that is globalized. So there's a little bit of whiplash from these countries too, because we did everything you wanted for the last 30 years, and it worked well. Why are we changing our minds? So I'm wiggling around in your question because I don't have an exact answer. I think the answer to your question is the United States still has a lot of pull, but a lot of these countries now have to make decisions about what they think the United States is going to look like going forward. And there's a lot of unpredictability there. You could get a new president in the United States that is much more populist than Biden, or much more willing to kind of go along with Trump in defying conventions and doing different things. That's bad. Even Biden, who's a fairly conventional president, is very protectionist, very make America great again, even though if he's not going to use that terminology because it belongs to somebody else. So I think we are looking at the steady decline of the United States exercising that power. And even if it's exercising that power now because it's sort of at a maximum moment of power before it loses it, every use of that power also makes it that much weaker.
Well, it gets to something that you just said, which I found very striking, which was the biggest threat to geopolitical stability in most parts of the world right now is the United States, which is strange to think about because we're so used to viewing it, at least, us as Americans. I know we have a fairly global audience here, but we're used to seeing things through the prism of the United States. So to view us as the disruptor is not something we're used to. You have to wrap your head around that a little bit. And this was an interesting piece that came up on the Knowledge platform this week that one of the members of the team was writing about. So NVIDIA, which obviously is a US company, they started shipping their new chips, their A100 chips, to China. And what they did was they limited the interconnect bandwidth on the chips in accordance with what the US was demanding, but they kept the computational performance the same. So this is getting into deep technical stuff, but I just wonder to what extent you see fudges like this, where you're adhering to the letter of the law, maybe not so much to the spirit of the law, and the US is kind of okay with that.
I didn't see the NVIDIA stuff, but I believe it was Alibaba and one of the Chinese companies they're working with. The way they're going to skirt the sanctions is they're actually going to decrease the performance of some of the chips that they were making so that they don't actually fall within the exact restrictions of the United States. Sure, that's a way to fudge it, but think about what that means. Like, that means that we're going to make inferior product and have less efficiency and less productivity so that we don't run afoul of some arbitrary restriction from what is supposed to be the leader of freedom and globalization and liberalized capital markets. Like, it's like a kind of blows your mind sort of thing. It goes back to about the United States really being the most unpredictable actor in the room. Russia stole that title, unfortunately, this year. But when we're dealing with the United States and China, China's not the unpredictable one. It's, to your point, is the United States going to allow that? Is it then going to impose a new rule that gets around some of these different fudges? We don't have the midterm election results yet, but let's say that the Republicans do take the House, as people normally say, or as most of the projections are indicating, even if it is by a slim margin. When you have divided U.S. government going into after a midterm election, usually you get foreign policy as the thing that a president wants to focus on because it's the only place he can actually do things. And China's the one thing the Republicans and Democrats agree on. So maybe they're just going to, tighten the screws even more. It's really difficult to say there, and it matters. Now we're in the realm of bureaucratic nonsense and things like that. I will say the United States probably has to let those fudges go, because if it doesn't, the entire economy is going to grind to a halt. I mean, that's how much we're all dependent on these semiconductors. I'll get on you can play therapist, and I'll get on the couch here for a second. I think I told you we replaced our freezer a while back, and it took like a year for the freezer to come here, and the circuit board and the freezer's already broken. So now they have to order a new circuit board. So that's another chip, and they don't have the part to ship until right now. They're telling us December 30th. So this is like a stupid freezer that's not going to affect national security, that needs one stupid chip to register the right temperature in the freezer. And I'm now, 18 months into the process of buying this freezer. Like, if that's the future of like global supply chains and the global economy for some of these semiconductor trade restrictions, like, I know I'm like, it's one very tiny anecdote, but that's the sort of stuff I start to worry about. And that's the sort of stuff that your fudging is going to lead to. One fudge may seem fairly innocuous, but if that starts to work all the way down the chain in all these different industries, God, it's no wonder we have inflation, because nobody can get their hands on the things that they need because the system isn't working.
Well, this is why I'm a little skeptical that we're going to see the most extreme manifestations of this. And we talked about this last week, where we talked about, when the rubber really hits the road and you can't get your freezer for 8 weeks or 10 weeks because of a shortage, or you can't get a new car because of some weird shortage. What are politicians going to do in the United States? As the dead Kennedys said, give me convenience or give me death. Our mantra is make things easy, make things available. And if we don't get that, there's a political response, I have to imagine.
Yes, but you can't possibly think at this point in your life that the response is going to be sensible policy to fix the problem. Like, the response is going to be more political polarization or demagogic focus on something else, or we're going to start debating what genders are allowed in bathrooms again, or what national anthems could be sang at basketball games. Like, that's the direction that politics is going right now, not actually fixing these things.
Yeah, some crazy policy in the other direction, I'm sure. The other thing I wonder about, and this is sort of an impossible question, and it's not really your area, it's really a political question, is, has the influence of American business declined so much that these sorts of bills get passed and enforced without them exerting influence on this? Like, it's in nobody's interest to do this. No businesses want these supply chain disruptions. No businesses want to deal with this. It's not good for business. And, as Calvin Coolidge said, the business of America is business. Since when has that not been the case? Like, why are we not seeing more resistance to these shooting ourselves in the foot kind of policies, do you think?
I'd say the business of America is self-delusion. Some parts of the economy, it is good for them. Like, Intel loves all this. Like, all the folks that want to take the place of all these Chinese companies absolutely love it. Like, there are parts of the economy that don't mind this. But I think you're right. You've seen this, like we were talking about Germany earlier. German industry doesn't want any of the harsh restrictions against China. U.S. companies, if you go through and actually read publicly traded U.S. company forecasts, they're all still betting that they're going to sell into the Chinese market, and that's how they support most of their growth projections, from a Starbucks all the way down to a Boeing. That's why I brought them up earlier. So there's definitely opposition there at an industry level. But this gets to polarization and populism versus, who's actually in Congress and who's making the rules and who's making the laws. There has been somewhat of a breakdown there. But I do think you're right that if things got really bad, you would see a significant pushback from U.S. industry. And that's why a bunch of these semiconductor companies got exemptions from the most onerous parts of these restrictions for a year. It's more the uncertainty that it's injecting into the system than we're talking about right now, rather than things grinding to a screeching halt today. Yeah.
And where do the Europeans fit in? Because, there was a piece that we were looking at together that I think was talking about how they're very much on the same page when it comes to the Inflation Reduction Act and their annoyance at the U.S. Provisions favoring U.S. Business and U.S. sourced supply and things like that. What do you think is the natural reaction for them? How does it affect sort of U.S.-European relations? What comes out of this if we continue to pursue these policies? Does it have tangible effects on what traditionally has been a fairly strong and positive relationship with Europe?
I think the transatlantic relationship was irrevocably changed by the Trump administration. The Biden administration has really focused on repairing that relationship and papering over the cracks as much as possible. But in all the European capitals, what they saw from the United States from 2016 to 2020, they now have to prepare for that as a worst case scenario going forward. So they're not thinking in terms anymore of the United States being that dependable ally. It's one of the reasons I'm so bullish about the European Union. It was the first moment where they had to wake up and realize that they were going to have to do things themselves. Now, that doesn't guarantee antagonism. It just means that there are going to be areas where Europe and the United States don't agree. This is also one of the reasons that Putin's invasion of Russia is so dumb, because without doing anything, Putin was seeing the Europe-U.S. relationship fray a little bit by invading Ukraine the way that Russia did. It has actually given Europe and the United States a common cause here in Eastern Europe, at least for a while, which allows you to paper over those cracks. But the cracks are there. Like, the United States and Europe are not necessarily rowing in the same direction on foreign policy. Or I should say, they're not rowing in the same direction on economic and industrial policy, even if they are broadly aligned on foreign policy and sort of explicitly geopolitical things in general. So yeah, expect to see more competition, more friction, more euro-dollar competition. Like, I think that's the world that we're moving towards. And again, competition doesn't mean enemies. Like, friends can compete against each other, but it's not now all working towards part of a global whole. It's about every single region of the world being able to do and have its own self-sufficiency.
And keeping on Europe, one thing that people have not been talking about, given all the Fed and related news in the past few weeks, is the proposed changes to the Stability and Growth Pact rules. I'd like to ask you a little bit about that, because we had a conversation internally. We have this thesis that's very bullish on Europe. We've spoken about this a lot. And internally, we've set guideposts. What would we want to see to show that our thesis is playing out or not? And one of those guideposts that we identified is fiscal policy that tends toward the loose, Stability and Growth Pact policies or restrictions that tend toward the loose rather than the tight, the less rigid rather than the more. And these proposed changes to the Stability and Growth Pact sort of approach, which in summary, they give countries much more leeway to identify their own plans to reach certain goals in terms of deficits and debt levels over a certain number of years. So it's very country by country. We'll leave it up to you. Just show us you're heading in the right direction. Whereas previously it was much more mechanistic, much more rules-based. I interpret that as a very bullish sign for our thesis, if that does indeed get through. But I wonder what you think.
With the proviso that I need to read the things a little bit more closely, and that European bureaucratic nonsense takes a long time to read because it's not exactly the most uplifting or flowery language in the world. Look, I mean, I think you're also probably already infected by the mindset of Paris. This is what France has been talking about for years. When Macron first came to office, his entire idea was a European Union of different concentric circles, where there would be a core European Union that really was in lockstep economically, politically, even on a security military basis. countries that didn't want to take part in the security aspect, but wanted to take part in the economic aspect, that you needed to create some kind of structure so that they could be in the concentric circle there. And that was what Macron was pushing Angela Merkel to do. It's what the French have been pushing the Germans to support now for years. The French have even blocked moves to expand the European Union in the Southern Balkans until some of these issues are resolved. So I think in some ways what you're talking about, if this goes through, is a little bit of a French victory. This is what they want because they see the path towards a stronger European Union, to your point, being a weaker European Union in some ways. So is it bullish? I don't know. There's a lot of distance to pass between a proposal to change some of these rules and these rules actually being approved by everybody, because they still have to be approved by everybody else. But yes, like Europe is having the right conversations. I will say one of the biggest threats to my thesis about Europe is that they just continue to have conversations and they don't do anything. I would like to see more action. I would like to see stuff that is actually passed. I would like to see integrating some of these countries into the European Union. That to me would be more of a confirmation thing, but it's a good start. It's nice that they're talking.
So here's the theory, and it could be total bullshit, so please tell me if so. You could say that the inflation spike, in many ways, is one of the best things to happen to the EU, and here's why. So, as you mentioned, this is a French victory, which I think is good. Not just because I'm a Francophile, but I think for the benefit of the EU, that's the approach that's going to be most effective. I've heard speculation that this sort of fiscal victory for the French on the Stability and Growth Pact oriented policy is being offset by a giveaway to the Germans on monetary policy. So we said we don't want to talk about the Fed, but we will talk a little bit about the ECB, because the ECB in the last 2 weeks has come out and been real hawkish in a way that I think has surprised some people in a major way. And they're using the terms. There was a Bloomberg piece that ran, and the hat tip here to Ryan Bridges, your good friend and analyst who focuses on Europe, to bringing this to our attention. There was a Bloomberg piece that ran that talked specifically about wage price spirals in Europe. And then one of the members of the ECB board just yesterday came out and used the same term. It was De Guindos, said, we don't want to have basically step stairs of wages and margins, which I think is supposed to mean wages and prices. So this narrative now is coming out, and that sounds like an awfully German way of thinking, because the Germans have to be concerned about losing their productivity advantage and their wage advantage when it comes to export markets. So I wonder if you are getting sort of a quid pro quo where the ECB is going to be more hawkish, really get aggressive in trying to stamp out inflation, so you don't get, the Rheinmetall industrial labor group securing 10% wage increases, and then next year energy prices go back down and you're stuck with higher unit costs. I don't. I'm sort of rambling here, but I just wonder if that's the essential quid pro quo that was made. If so, it's probably a good thing for the long term, if that is indeed what's happening.
A lot of ifs there, but I agree if the ifs kind of fall, as you say. I mean, Macron himself was out criticizing the ECB this week, saying they shouldn't be too hawkish because they might, destroy European growth. By the way, European growth doing better than folks expected. German industrial production up more than most global forecasts suggested. So lots of forecasts wrong this week. The inflation print wrong, polls in the U.S. wrong, the margins on Lula's victory wrong, German production wrong. There's a lot of stuff that is kind of, it looks like our tools for measuring things are not really accurate, or at least they're less accurate than they normally are. But that's probably a whole podcast in and of itself. Before we let listeners go, Rob, I know we wanted to touch a little bit on Brazil. So why don't we talk about that for a second before we say goodbye to our listeners? So we talked a little bit about the election last week and why we're optimistic on Brazil. But tell me a little bit about what you're seeing this week and how we want to update folks.
So, in full disclosure, we've recently put on a tactical position long Brazil post the election. And today, the currency and the equities are down a couple percentage points. And the reason seems to be concern over a kind of political negotiation that Lula has made. So, remember last week we spoke about Lula's really limited fiscal space to do stuff, and that people were worried about profligate spending, fiscal deficits, and we noted, he doesn't have much control over such an enormous part of the budget in order to do those things. And the deal that they've appear to have struck is that they're going to agree, Lula in the legislature, which remember is controlled by the center left, the center right. So essentially Bolsonaro supporting groups, they've agreed to take the Bolsa Familia social program out of the regular budget, and the resulting space will be free to make investments or spending or however you want to call it, depending on if you view it through a positive or negative lens. And most market participants are viewing this as a really bad thing. They're viewing it as Lula on the path to irresponsible fiscal spending. And I don't come away with the same interpretation. This seems like a fairly sensible negotiation between two parties at loggerheads, two groups at loggerheads, on something that's fairly sensible. Bolsa Familia is generally regarded as a successful program. It's been around for a long time. Both parties have supported it. I don't think it changes anything fundamental, and I would view this more as an opportunity to fade the overreaction. But I wonder what you think.
I continue to think that when it comes to Brazil, and not we, but the sort of collective we out there focuses way too much on personalities. It took all of a week for us to go from saluting Lula, the savior of Brazilian democracy, to, Lula, the communist monster who's coming to destroy Brazilian economic productivity. Like, it's just too simplistic. And exactly to your point, like, go look at, it's a very, very simple data point. Just Google Brazil's Congress, or go beyond the presidential election result and look what is actually happening throughout the country. This is not 2003. Lula doesn't have that kind of mandate. It's not that kind of world either. And he's an old fogey who didn't campaign for anything. He's actually been the biggest problem with Lula right now is how coy he's being about who he's going to put in the cabinet, what his plans are. I would imagine because he doesn't know. He doesn't know who he can get support to be in the cabinet, or what positions he's going to be able to get enough support from. And he doesn't want to hang out there and look like an idiot for proposing one thing, and then Congress slaps him upside the face. The Bolsonaro supporters, after Bolsonaro, or not even after, but before Bolsonaro even conceded the defeat, came out and said, we are going to be the toughest opposition Lula's ever had. They've put all of their political capital into resisting Lula. So Lula doesn't want to make a Biden-type mistake where he comes out with a $4 trillion stimulus and it gets whittled down into a $1 trillion thing because whoever the Brazilian equivalent of Joe Manchin can hang him up. I'm mixing my metaphors there a little bit. But yeah, I think you're exactly right. Like, it's a great example of, I don't think people focus on Brazil that much. They think just because they know a thing or two about Lula or a thing or two about Bolsonaro that they can explain one of the largest economies and most complex countries in the Western Hemisphere. And you just can't. And if you actually look beneath the surface, a lot of what's going on in Brazil looks good. The thing that concerned me this week had nothing to do with Lula. It was inflation ticked up a bit in Brazil. And we had already seen, like, Brazil was one of the leading indicators with inflation. They were one of the first to be hawkish. They were one of the first places where prices started to go down a little bit. I didn't like that I saw a little bit of an uptick with inflation there. Even so, though, the Brazilian central bank still saying they're looking towards cutting rates, maybe not hiking rates into the cycle. But that's the boring place where we need to talk about what's going on with Brazil next, not with, oh God, it's the pink wave and Lula's taking over and is going to do all these terrible things. Even if he wanted to and had the energy to, which he doesn't look like he is that man from 2003, he doesn't have the political power to do so. it's really can he convince people to go along with enough of his program to make a difference? I don't know. We'll see. But I think the focus on Lula and the narrative that has emerged around him is way too simplistic and misses all the important things. That doesn't, by the way, mean that we're right, because market sentiment does play an issue here. I can't remember if I complained about this last week on the podcast or not, but I had a thesis on Tencent earlier this year that has been absolutely right in every single way geopolitically. Just hasn't worked the way we thought it would from a market perspective, because the sentiment is completely against reality. So like there is something here about how people perceive Lula based on the fast food level of discourse that comes out of analyzing these things. That also creates its own things. But in terms of the fundamentals, I think you're absolutely right. Nothing here has changed. Everything is still that Lula's not going to be able to do all these things that people think he's going to do.
Well, shall we say goodbye for this week?
I want to put one more thing in listeners' minds, which is I don't have any great analysis about this, and I don't even know exactly what I think about it. But in the sort of realm of things that, well, not things that catch my eye. A lot of what I do on a daily basis is I'm reading things, and I could care less about things that confirm my viewpoints. I'm always looking for things that I don't understand or things that contradict what I expect. And I got a big one of those this week, which was the IMF agreeing to a $4+ billion bailout package with Bangladesh. That makes some sense. Bangladesh is a major energy importer. Their biggest export is clothing and textiles. And because of recession fears, those things have taken a hit. But Bangladesh is also one of the great economic growth stories of the past couple of years. They've generally done very, very well. I was a little taken aback that the IMF and Bangladesh reached that deal that quickly. It could just be very good policy. Could just be, hey, it's there just in case, but it's not actually a reflection of things that are bad. It could have stuff to do exactly with textiles and clothing in general, because Bangladesh has an outsized exposure to that. But I got a little tingle down my spine when I saw that. That told me that maybe something else is going on in some of these developing markets that people aren't paying attention to. And another reason that makes me concerned is, folks know that I'm this European energy crisis. I'm increasingly confident that I got that right, that there isn't a European energy crisis. But the next follow-on point there is that the presence of rich European countries buying up energy supplies from around the world is that countries like Bangladesh are going to get screwed. We've already seen that a bit with Pakistan. We saw it a bit with Sri Lanka, but those places really haven't had a lot of success and have a lot of other problems, political problems that exacerbated those issues. Bangladesh is sort of a different story. If we're getting sort of disease is the wrong word. If we're getting signs that like the Bangladesh economy is doing really bad to the point that it needs an IMF bailout, I start to get worried about global growth and global trade and what that tells us about the way things are going. So I don't have anything more to say there. I don't know which direction I'm going, but that's one thing that came across my desk that made me a little nervous this week and that I'll be diving into over the next couple of days.
Potential canary in the coal mine.
Maybe, but I mean, it's also I don't want listeners to run for the hills now because I said that. Roger Baker, who's been on this podcast before, used to tell me when you're looking for anomalies, 9 out of 10 times you're going to do the research and everything's going to be fine. So you do the research, do the hard work, so that if the 1 out of 10 times is the canary in the coal mine, you're not surprised by it. So I would expect at this point for it to be the 9 out of 10, but it was enough. It bothered me enough that I'm talking about it here. So you can tell that it's like sticking in my head, kind of a little bit. So anything else on your mind, Rob, or time for you to go get some triple cream brie?
I was just thinking if we were a really effective media organization, we'd be playing up the 1 out of 10 time and saying Bangladesh is about to sink into the ocean and everyone tune in next week. But the reality of day-to-day implementation of what we do is a lot more banal.
Bitcoin contagion. The collapse in Bitcoin cryptocurrency markets has led to the complete and total debacle of the global textile industry beginning in Bangladesh. Next time on the Cognitive Investments podcast.
That's more like it.
There you go. Cheers, y'all. See you out there. Thank you so much for listening to the Cognitive Dissidents podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.